Let's carry this conversation forward. Adrian Mowat, investor and a well-known India watcher, is joining us from I think, Hong Kong this morning. Adrian, thank you for joining in. Always a pleasure speaking with you. You know, we're living in very interesting times, and I want to get your view on first what IT earnings are telling us. It's only adding to the confusion, right? The market here was not prepared for US clients turning off the money tap so quickly. But that perhaps tells you what's happening in the US. But if that's an indication of the economy, that's definitely not reflecting in the stock market, right? At least the US market is up and away. India has been range bound. What do you make of things, all things put together?
Okay, so if we take a stock that's done very well in the US this year, Meta, the holding company for Facebook. So Meta's share price is rallying from very low valuations. You know, it was a single-digit multiple. And it rallied because they've been cutting costs. They're spending less money on the metaverse. And so it's very logical that that company with very high free cash flow and increasing free cash flow is rallying. But how are they rallying? They're rallying because they're laying off staff. They're rallying because they're cutting costs. And it's very important, you know, we tend to think that the stock market has to directly reflect the economy, but you need to be conscious of the composition of indices and, you know, these big mega stocks that drive the indices, what is driving them. So I think it's logical that the narrower NASDAQ 100 is outperforming the broader NASDAQ composite. It's logical that you're seeing the Indian IT services industry being the wrong side of corporate America cutting costs. So you know, to me, the market is very logical, but you need to understand what's driving these big stocks in the market. And you know, what you've got in the situation with the US market is it's a narrow move. Big mega stocks that are cutting costs are moving higher. When you look at the broader, you know, like the Russell indices, et cetera, that might be a better reflection of what's going on in the economy.
Okay. Adrian, hi, good morning, and always great speaking to you here on CNBC TV18. How are you feeling about India now? It's been a bit of a painful period, right? The market has been under pressure. It's frustrated investors. There's been no recovery coming through. But somehow we've weathered the storm so far. Do you reckon that the second half of the year could see a big up move? Because that's the narrative now, that perhaps the worst of the bad news is in the price, and now the market will take a turn for the better. Would you concur?
Okay, so the market is down modestly this year after being a significant outperformer for a number of years. There isn't anything particularly wrong with the economy. The currency is relatively stable. The issue, as we've discussed in the past, is what are the opportunities available out with India? And so in the larger markets, the United States, as I was discussing earlier, we've got a cost-cutting story. We've got a story with the large money center banks benefiting from some of the stress that we're seeing in the financial system as deposits move towards them, and they then get very, very strong net interest income, which is what came through in the results for JP Morgan. And then when we look at the emerging market space, today we had the GDP numbers out of China. Those were above expectation. I was particularly interested in strong retail sales numbers as evidence of consumption rebounding nicely as we leave this sort of very unpleasant zero COVID policy that dominated much of 2022. The tech sector in Korea and Taiwan have been performing well. That's probably more of a recovery trade after being the worst performing markets in 2022. So you've asked me a question about India, and so far I haven't really said very much about India, but it is partly a story of there are other opportunities. There's a bit more delta elsewhere, which is encouraging investors to move to those markets. I think when we're trying to look at what is the trend in the Indian market at the moment, and that's quite difficult to define, isn't it? There isn't a clear sector trend. Now, there might be now an underperformance of the IT service sector. Your best performing stock year to date is ITC, which tends to reflect a relatively, defensive bias in investors' thinking. HDFC's kind of done all right, but some of the other banks have gone down. And I think also, one would like to sort of on these shows say, right, well, this is what I think is going on. But at the moment, as I look at India and talk to other investors in India, we're not entirely sure what's going on, but we can see some trends in other markets, and perhaps that's why you're seeing the sort of relative underperformance.
So, Adrian, China, Korea, and Taiwan, they are ahead of us in the pecking order, right?
They are, and I think the other issue here is we tend to talk about this sort of idea of a recession and that everything is synchronized, everything goes badly at the same time. But you've had your manufacturing recession, you've had a deep inventory destocking going on in the tech hardware space. Apple, who you've been talking about earlier, Apple had their worst quarter in terms of MacBook sales, PC sales for 2 decades. All the recession is kind of there already. And to some extent, there are thoughts in the Korea and Taiwan that these very cheap markets are more of a recovery trade going into next year.
So, Adrian, to come back to your point, you made a very interesting observation that no one quite seems to know what's going on in India, right? Let me make it more difficult for you and ask you more on that. Any guesses what's happening? And let's leave aside IT. I think we've discussed that. There's a lot of money that the government has been spending on capital expenditure, and we keep hearing that narrative that that's where you need to be invested because there's a capex cycle coming back after a decade. Do you agree with that? If not this side of the market, does anything else look interesting to you right now?
So, your capex point is also reflected in the leadership, isn't it? So you've got the cement companies doing well, L&T. So I think people would concur with that as a theme. And the infrastructure spend that has gone on in India is a meaningful improvement from when I started looking at the market. And it's effective. And that, the market agrees with that. But it doesn't sort of feel like, well, you've got to go and buy these companies today because people don't know it's going on. I think they know it's going on.
Okay. Adrian, you know what, just one final word. I mean, since you're talking individual sectors and stocks, there was a note that CLSA put out this morning where they had a road trip across Singapore, Hong Kong, to speak to investors on what they like in India. And one of the spaces that they like is autos. They say that, autos are coming back, stock prices have fallen, demand is resilient. Is this a space you think could sort of outperform the Indian markets? Is it a space that you look at closely?
Well, these stocks are up year to date, right? So they are outperforming the market. So yes, I mean, I think the Indian consumer seems fine, reasonably robust. And yeah, it's working at the moment. I don't see any reason why it shouldn't continue to work. But these are the outperformers year to date. And that probably makes a fair amount of sense.
Right, final question from me, Adrian, before we let you go. What are you factoring in with regard to the Fed action? I'm looking at the Fed tracker, and most on the street, well, they are factoring in the 25 bips comes about, in the coming May policy meeting. But post that, do you expect more hikes? And are you factoring in a cut towards the end of 2023 or 2024?
So I would expect one more hike, and then we plateau at that level for the forecastable future. What would need to occur for the Fed to start to cut rates? You'd have to see a meaningful weakening in the labor market. The most recent labor market data was about 250,000 new jobs created. So I think there is a disinflationary trend going on. Mohammed Al-Arian was talking in an earlier piece that you had but inflation is still high, even there is deflation going on. So I think you hit a plateau, and we hold there at 5.25 for the balance of the year, unless the contraction in bank lending gets more severe, and you begin to see that being expressed in a rapid deterioration in the labor market. I suspect that's not going to happen. There's a fair amount of momentum in the US economy. And so we'll just have to learn to live with it. 5.25%. What you've got to remember about that, though, is if I'm getting 5.25% on overnight cash, finding interesting investment ideas in higher risk assets is going to require them to be offering me a higher return. And that's something we've all got to reflect on. And it means that P multiples that we've seen during the zero interest rate environment are not going to be seen again.
Got it. All right, Adrian, we'll leave it at that. Thanks a lot for joining in and speaking to CNBC TV18. Appreciate your thoughts. Well, that's the word coming in from an emerging market expert. They say that there are better markets to invest into rather than India, and investors prefer other Asian markets. Let's slip into a quick break on that note. On the other side, plenty of stocks to talk about. Our entire research team will be with us in just a bit. Stay tuned.